Why does one stock behave like a sleepy cat in the sun, while another stock moves like a squirrel that just found an espresso machine? That difference is what beta tries to measure. Beta tells you how sensitive a stock is to the overall market. Or in plain English, if the market moves, how violently does the stock usually react? Beta compares a stock's movement to the movement of the overall market, and it's usually S&P 500. So a beta of 1 means that the stock tends to move about the same as the market, above 1 that it moves more than the market, below 1 that it tends to move less than the market. So basically, beta is stock market's drama level. If you're not a nerd, skip next 20 seconds. For the rest of us, here's the formula. Beta is the covariance of stock returns with market returns, divided by variance of market returns. That may sound intimidating, but the idea is very simple. Beta asks, when the market moves, how much does the stock usually move with it? It is not measuring total volatility or total risk. It is measuring volatility only related to the market. So quick example. Let's say a stock has a beta of 1.5 and the market goes up 10%. The stock might be expected to go up about 1.5 multiplied by 10%, 15%. But if the market falls 10%, the stock might be expected to fall about same negative 15%. This is, of course, not a guarantee. It is a rough expectation based on past behavior. Beta is not a crystal ball. It is more like a weather report from a slightly overconfident spreadsheet. Here are some examples with basic beta levels. So beta 1.0 moves roughly with the market. An example would be like a broad ETF spider, for example, or a large diversified company like Microsoft. They would have a beta of close to 1. Beta greater than 1, specifically beta around 2, would be NVIDIA, much more volatile than the market, higher upside, higher downside. The beta less than 1 would be something more conservative like Duke Energy or other counter-cyclical companies. Beta around 0 is extremely rare to find. But if we're looking to find a financial instrument that would have beta of around 0, that would be 30-day T-bills, barely related to market movements. Same thing with negative beta. Technically, it's supposed to go against the market. They are extremely rare. Sometimes biotech companies and commodities can temporarily experience the negative beta. So why is it important? Investors use beta to understand portfolio risk. If you own several high beta stocks, your portfolio may rise faster in a bull market, but fall harder in a bear market. Beta also appears in CAPM model, which I will explain later, where investors estimate the required rate of return on the stock. Higher beta usually means that investors demand a higher expected return. And important thing to notice what beta misses. First, beta is usually based on a historical data, and the future sometimes may not look like the past. Second, beta only measures sensitivity to the market. It does not capture company-specific risk like bad management, debt problems, lawsuits, etc. And third, beta can actually change over time. A company may become more stable, more risky, or completely different from what it used to be. So here is the clean definition. Beta tells you how dramatic a stock is compared to the market. Beta of 1, market level drama. Beta above 1, some extra drama. Beta below 1, some calmer behavior. Useful? Yes. Perfect? Absolutely not. It is just one tool, not the whole toolbox. If you like this explainer, click like and subscribe, and I will see you next time.